Hi, I'm Viktor Derganov. Welcome to the Financial Profit. In this week's profit report, we're going to discuss tariffs. Are they good or bad? Inflation, the increasing potential for a recession, the drop in markets and key equities, of course, whether we're seeing any buying opportunities out there, and much, much more. We have an incredible show lined up for you, so make sure to stick around until the end. So this week, we're going to talk about why the Trump tariffs are so painful. And I'm sure you've noticed that we've seen quite a bit of volatility recently. Last week, I put out an article, Buy When There's Blood in the Streets, and this was right when we were starting to really see some of the more significant selling coming on board. And it kind of, transitioned into this week when we actually saw a massive 4% decline in the NASDAQ on Monday. So we're seeing that the Trump tariffs are quite painful because we saw some pretty incredible moves on Friday in markets. It seems like 99% of people automatically assume the tariffs are a bad thing. Now, before I dive into some details, I think it's very important to consider that there are always two sides to every coin. Regarding tariffs, I view them as potentially inflicting some short-term pains while providing many favorable and constructive elements in the intermediate and long term. However, before we discuss some positive elements concerning tariffs, let's address the potential negative implications first. After all, it's the tariff mess that has markets on edge, and we've seen signs of panic as volatility spikes to its highest levels since last summer's growth scare. So, markets aren't exactly crashing if you exclude Monday's 4% drop in the NASDAQ and other significant moves. Otherwise, we've basically seen pretty orderly declines. But nonetheless, it's been a painful several weeks due to the segment's heavy weight. Now I'm talking about the QQQ here. QQQ is the NASDAQ 100 ETF. So it's mostly, for anyone unfamiliar with this, it's a compilation of the major technology companies, and some of the most heavily weighted stocks in the QQQ ETF are companies like Apple, Microsoft, Google, Amazon, Tesla, Nvidia, Meta, and other tech giants. Now, first, let's just go back to this. First, we had a mild volatility storm, which began around mid-December. We witnessed about a 2-month consolidation pullback phase, after which the market failed to make a notable new high in mid-February. We also witnessed a lower RSI, that's the relative strength index, during the second price peak, creating a negative sell signal technically. Now, around this sell signal, we did take some profits in Tesla and some other stocks. We also implemented some hedging strategies via covered call dividend strategy, selling covered calls, as well as implementing other strategies to limit some of our downside during the more volatile phase in markets. So let's take a look at the S&P chart. So we dropped all the way down from 6150 all the way down to 5,550. So we had a 10% decline in the S&P 500. Now, whether this is a potential dead cat bounce or whether 10% is enough and we're not going to see any more downside during this downward phase, this remains to be seen. Nonetheless, 10% correction is very substantial, and we are likely at least going to see a 3 to 5% rebound before we are able to reassess whether this is really a lasting rebound, or if there will probably be more downside in the near term. Nonetheless, we're seeing extremely oversold technical conditions. We saw the RSI go below 30, which is actually lower than where the RSI went during the August crash, and is about on par with the bear market lows that we witnessed in 2022. Now, we also see that the CCI went very negative to negative 200, which is something that we only saw back in the April correction, after which we saw a really solid rebound. And we also witnessed a similar low level during the August crash, after which we saw an extremely robust rally. And we're seeing a similar dynamic in the full stochastic, and we can also point our attention to that we are considerably below the 200-day moving average, which happens very rarely. We witnessed a fall below the 200-day in August. So, and I believe in the April correction too, which also illustrates a high probability that we will likely see a lasting rally soon. So the collection of these factors looks like we are witnessing a constructive correction. It's gone 10%, which is typical for a substantial correction. Now, the base case scenario here seems to be that, we've seen a 10% correction. Possibly it's enough. and potentially the market could start recovering here, and maybe all we need is some positive news flow or just something to switch that sentiment around, and we could see a considerable rally. Let's talk about why the quote Trump tariffs may be bad. Now, everyone seems to bring up inflation due to higher costs as the primary negative near-term concern. We may also see a consumer slowdown due to the higher prices from the inflation and higher costs in general. Now, this dynamic could cause a deep enough slowdown to potentially trigger a recession, which is what the market is afraid of most. Then there's the fear of the potential retaliatory tariff threats, which could put pressure on U.S. exports. Ironically, the EU, Canada, and other countries have used tariffs, the VAT tax, and other equivalents of tariffs, and I can't blame them for this, to gain an edge for their domestic industries and rake in more money for their governments. Now, they did this while blocking imports and making them more costly from the U.S. Therefore, it's a bit strange that some countries are saying, hey, America, what are you doing? When they have used, these tariffs and the equivalent of against the U.S. in excess, I would argue, for many years. For instance, Canada has a 250% tax on U.S. dairy and similar tariffs on grains, eggs, poultry, other products as well. Now, I have nothing against Canadians. I love Canada. I've been there several times. I think Canadians and Americans, they're not even like neighbors. They're the same people, basically. They just live in different countries. And I'm all for America and Canada being separate countries. But at the same time, there needs to be fair trade. It's remarkable. But the U.S. had a $63.3 billion deficit with Canada last year. Of course, due to its heavy reliance on the U.S. market for exporting its goods, Canada is much more, I want to highlight this fact, much more impacted by the tariff threat here. Most of Canada's industries rely on the U.S. for 74 to 100% of their exports. Listen to that again, 74 to 100% of all their exports, which is just staggering. And this is while only 18% of the U.S.'s exports head over to Canada. Now, I'm not trying to downplay Canada. Canada is the biggest export destination for U.S. products, but nonetheless, compare that with 74 to 100%. Therefore, Canada, now again, facts are facts, regardless of your feelings, regardless of my feelings. Facts are the facts, and I will continue presenting the facts. Canada is in a much weaker negotiating position, which could enable progress on improving trade relations heading into April. I'm just trying to make logical comments. There's a similar but a much more considerable dynamic with the EU. Last year, the U.S.'s trade deficit with the EU reached a staggering $235.6 billion. Now, while the U.S. levies only a 2.5% tax on EU cars, the EU has a 10% tariff on U.S. cars. Now, please consider how much Mercedes, BMW, and other European companies' sales could plummet if the U.S. institutes a 25% tariff on EU cars. Just imagine that. How many people do you think will go and buy a Cadillac or a Lincoln or whatever instead of buying a BMW or a Mercedes? They could go to Lexus. They can go wherever just to avoid paying much higher prices for German cars and other EU vehicles. Now, just think about that from the European point of view. What are they going to do? How are they going to negotiate to avoid this from transpiring? And this brings me to my next point, that it's unlikely that German auto and other crucial industry executives would want this highly negative dynamic for their companies because, they would lose billions and billions of dollars. Therefore, the EU will likely come to the table and attempt to improve trade relations, potentially making them fair between the EU and the US. Now, I want to stress this point, that no one wants an all-out trade war. A reduced trade deficit favors an increase in U.S. GDP. So just the tariffs and reducing the trade deficit is favorable to American GDP because, that's how GDP is calculated. Also, no one wants an all-out trade war because it would not be in anybody's interest, especially outside of the U.S. I made this argument in Trump's first term, and despite some trade tensions with China and other partners, there were not considerable disruptions from the trade aspect during Trump's first administration. Therefore, countries including the U.S., China, the EU nations, and others will likely come to the table to make concessions if they need to in order to avoid a costly trade war. And this is very, very important to remember, that the U.S. is the market where everyone wants to be. It's crucial to emphasize that the U.S. remains the most lucrative consumer market globally. Nearly 70% of America's enormous GDP goes through consumer spending, and every foreign company should want to participate in the U.S. market as much as possible. Foreign companies importing products into the U.S. may need to lower prices, decreasing their profitability to avoid losing market share in the U.S. markets. Talk about a tax that the U.S. consumer is going to pay? No. Much of the tax is going to be paid by the foreign company. The U.S. also has a vibrant, I want to stress this, that the U.S. has the most vibrant domestic small business economy that is setting up for considerable growth. And domestic companies should plug any gaps that tariff goods may create, enabling much more competition in future years. Just think of the increased competition of the domestic companies competing with the global companies, with the international companies, to deliver more and more goods to the U.S. market, which is what we're going to see, which is very healthy for competition, for prices, for the U.S. consumer, for U.S. and global business. It's beneficial for everyone. This dynamic favors competition. It favors capitalism, and it will benefit the consumer by delivering lower prices because of increased competition. And let's not forget about the $1.7 trillion in investments already announced for America because of tariffs. I would say that this is pretty positive. Actually, this is huge. Companies, massive companies like Apple, Taiwan Semiconductor, SoftBank, Oracle, OpenAI, and many others have announced that they will invest $1.7 trillion over the next several years in the U.S., in part to avoid the tariff threat. This should be huge for American jobs, American manufacturing, American industry, as these projects should create millions and millions of high-paying, high-quality new jobs. Furthermore, we may see more announcements of other companies coming in that are ready to build to get a head start on getting a favorable position in the U.S. market now, as it may become more challenging down the line. So basically, those that come into the American market first, build here first, put in their infrastructure first, are going to benefit the most. Also, I want to highlight that whatever is good for America is good for the whole world. America's economy and America have to be in a healthy place for the entire world to do well. Now, I think these are very important facts that are being dismissed by the mainstream media. They're being avoided right now, and there's so much emphasis going to all the negative factors that investors and people are really overlooking so many positive factors. And this goes to the fact that, yes, we may feel a little bit of pain in the near term, but in the long term, tariffs and other initiatives are not there to punish anyone, but they're there to put America in a much better, in a much stronger place economically, socially, and geopolitically in the intermediate and long term. Now, let's watch for inflation to drop. Trueflation shows inflation below 1.4%, spiked over 3% in December and June. It appears like the inflation spike may have been transitory, and we could see lower inflation, including a lower CPI reading that we just saw today. Also, this lower than anticipated inflation dynamic should enable the Fed to start easing sooner and cutting rates much more faster than expected. Rates should be going lower now to combat the future effects of tariffs. We should be seeing interest rates going lower to avoid the potential slowdown that tariffs could enable. That would be ideal. We should see rate cuts soon. Let's just bring up this recent CPI report, and we see that the CPI hit our Goldilocks zone, coming in at 2.8% instead of 2.9. So this is perfect because it's not too hot and it's not too cold. We did not want a number over 2.9, of course, because then that would signal that inflation is basically out of control and that the Fed can't cut rates anytime soon. On the flip side, we didn't want to see inflation go too much lower, like a 2.6 or a lower read, because then that would indicate that the economy is probably cooling quicker than anticipated, which is a growth scare. So we want to avoid that. Now, with a 2.8 print, we have a perfect read, because basically a 2.8 or a 2.7 says that we have inflation coming down, we have the economy and inflation on the right track, and now the Fed is likelier to cut interest rates sooner because inflation is declining faster than anticipated. So this is a beautiful inflation read. And Now, let's look at the Federal Reserve rate cut probabilities. So, seeing at about an 80% probability for a cut in June, which is not bad, but we really want to see that moving up to 90%. So, we want more data to come in to illustrate that inflation is improving, but we want to make sure that we walk a fine line, that the data that's coming in, it's not painting a picture of a worsening economy indicative of a potential recession. So instead, we want data to come in that's showing inflation is decreasing as anticipated, or by a little bit more than anticipated, while the economy is remaining resilient at the same time. So we could get Fed easing sooner, so we could have more stimulus for the economy, monetary and fiscal at the same time. So we want to see the June rate cuts, the probability moving up to 90% soon, which would make the May cut about a 50-50 probability. So we may even get a cut in May. And if we don't get a cut in May, then we could probably see a bit of a disappointment in the market with a pullback, which would set us up perfectly for then another rally and almost a definite cut in the summer. So that's kind of the game plan for the future there. Now, let's talk about valuations a little bit, because I know you're probably going to tell me that stocks are expensive by traditional metrics here. So we have about a 21 forward PE on the S&P 500. Some say that's expensive. I would argue that that's not. Also because some big cap stocks are still relatively maybe overpriced, arguably, while the equal weighted S&P 500 PE is only around an 18 to a 19 PE ratio, which is a 10-year average, even slightly lower, actually. Now, let's discuss this. We have to consider the economic environment that we are in. The Fed has embarked on an easing cycle of what they're saying about maybe not cutting as many times this year. I still think that the Fed is going to cut 3 to 5 times this year. So they're definitely on an easing cycle. We have a pro-growth president in the White House. Donald Trump wants what's estimated to be $5 to $11 trillion tax cut soon. Plus there's going to be deregulation, and there's going to be plenty of fiscal stimulus in my view. So there's enormous positive catalysts down the line. So we need to keep that in mind. While there's some initial turbulence to these tariffs and all this stuff, this is nothing compared to what we're going to see relative to the potential growth and rally down the line. I think that things could balance out relatively soon. I think that the market could get used to this, kind of tariff-related volatility. Markets can continue to do well moving forward. I would argue that the NASDAQ 100 is now cheap with a forward 25 PE. With all the AI prospects, there's so much talk about AI basically slowing down. But where's the evidence? NVIDIA reporting stellar numbers. We had Broadcom, we had Marvell, we had other companies reporting excellent AI demand and future growth, excellent guidance. So I don't see where this narrative, I know about the deep sea, but that doesn't mean that AI spending is going to slow down anytime soon. If anything, it's going to speed up because more companies are going to want the advantage. More companies are going to want the best chips. More companies are going to want the top and the best AI. And I keep saying this. This is not the race to cut costs. This is the race to dominate AI. Okay, so with AI and other catalysts, I would argue that a 25 forward PE on the NASDAQ 100 now is cheap. If you take away some of these stocks like Apple, and Microsoft, and Tesla that have, relatively high near-term valuations, then the equal weighted PE ratio on the NASDAQ 100 is closer to a 22 or a 23, which is dirt cheap. Also, let's talk about the Russell 2000. The small cap index looks extremely cheap around its current 22 to a 23 times forward earnings multiple. We have the tariffs. This is telling us that the domestic economy is gonna have more business. The Russell 2000 is the domestic economy. It's the companies that have the most exposure to the domestic market. These are the companies that are going to do well. I think a 23 to a 22 forward multiple on these is ridiculously cheap. And then again, going back to the S&P 500, the 21 forward PE here, also cheap. And again, no one said the recession is for certain, and nothing is written in stone. Instead of the dreaded recession, we may see tax cuts, fiscal and monetary stimulus, deregulation, AI growth, and other constructive factors push stocks substantially higher in future years. Do you have any idea how much corporate profitability could increase when the future tax cuts take effect? And how about the estimated, again, 5 to 11 trillion in potential tax cuts? I mean, how much money do you think that that's going to drive into the stock market during a period while the Fed is easing? That's going to happen in the next 1 or 2 years. These and other factors should impact the economy and the stock market very favorably. And I want to be part of this ride. Therefore, I remain bullish, keeping my 7,000 price target despite this volatility in the S&P 500, and I have a $600 price target for the QQQ ETF. I want to thank you for watching. I hope that you enjoyed this topic and that you like my profit report. I would love to hear your comments, so please join the conversation in the comments section if you'd like. Also, if you enjoyed my video, please click like, share, and subscribe. You can also follow me, Viktor Derganov, and please don't hesitate to join our highly successful investing group, The Financial Profit, at seekingalpha.com. I want to thank you very much for watching my video. I really hope that you benefited from watching my video. Thank you and have an amazing day.